Hello and good afternoon. I welcome you to today's Trading Spotlight webinar here with Atmar Markets on Friday. It's the 21st of August 2020 and my name is Jens Klatt. I'll be the moderator here for the upcoming something like 40-45 minutes on a very interesting topic today. So Forex trading with Martingale. In fact, it's not necessarily sad that we need to connect this to Forex, but also we can easily connect this to all other trading approaches. And it's a common way for people to trade Martingale. What this is, we'll define this in a few minutes. It's in fact that's something I can already say right now. It's a quite risky way, and it needs very disciplined if traded. And if you want to trade Martingale correctly, you need to be very disciplined. Have a clear plan of what you plan to do, a strict risk money management, because Martingale can easily result in busting your account. And we will start here, first of all, with the agenda for today. So first of all, as I already said, we will give an introduction. What is Martingale? And also run through an example here. Then also an example, especially in relation to Forex trading. And at the end, I will show you how you can adapt such a Martingale trading approach. What's necessary in terms of adaptations in general from a risk money management perspective, but also how to probably trade Martingale in a more sophisticated way, probably to play anti-Martingale, for example, a way to pyramid into trades. As I already stated, the very fascinating topic. That's me. So my name is Jens, as I already said. I'm in the financial industry now for nearly 15 years, or close to 20. I did an interview together with Atmar around 1 year ago. So we had our 1 year anniversary, our birthday here with the Trading Spotlight webinar series. Thanks to all of you listening to this, now watching this on YouTube. You made this a success, and we continue to think about optimization of the produced content. And your feedback is all the time much appreciated, and thanks for your thanks for your time and your for your questions and making this whole thing a success for us. But back to my person and back to the interview I did. It's 1 year ago that I did this interview, so you can find further information on my person, where I come from, what's my background, and how did I get started in trading, for example. You can find everything in detail in this interview. What's interesting is probably in regards to Atmar Markets, that I'm located in Berlin, in Germany. And Atmar Markets, this is noteworthy because Atmar Markets has offices around the globe, 20 and more offices around the globe. And in Berlin, here in Germany, there's one of these offices. It's around 20-25 minutes. And I'd be there within the office, in fact, and then chat with the team. And why is this interesting? Well, because it's something very important. I think some brokers underestimate how important it is to have really a native speaking office in a location within the country you are doing business in, because this builds a high level of trust. And that's one of the reasons why Admiral is in the market nearly for 20 years now, so 19 years, in fact, since 2001, I think. And it's beside very competitive trading conditions. You found there a great order execution speed in general, low commissions, very tight spreads and stable spreads. That's something which plays a very important role when choosing your broker, especially as a professional trader. But on top of that, the customer support and having someone to speak in your native language is, I think, crucial, especially when it comes to financial decisions and questions around this topic. So that's one of the main reasons why you should feel invited to visit the website atmarmarkets.com here. So this is an English-speaking webinar, but you will find a chance here to find your native language. I'm quite sure you will find it. It's a high probability. on the website and get all information on Admiral there in regards to the trading conditions and so on and so forth. And if you have any questions, feel free to reach out to them directly by phone. Now, let's have a look at today's topic, Martingale, and an introduction. What is Martingale here? So Martingale is based on probability theory and has theoretically a near 100% success rate. Sounds interesting, let's say. So sounds I think very, very interesting when it comes to trading, because you might say, well, great, trading Martingale means I have a 100% chance of success. In theory, that's the case, yes, but there's some limits to it. Theoretical means because you need a significant supply of money, or theoretically speaking, you need infinite money to achieve 100% profitability. And there are limits to the game, obviously, because even if you have infinite money, you still need to have a broker which offers you the position sizes, which is probably even beyond what is traded on a daily basis to fulfill your order, you fulfill your buy or your sell order, in fact. And why is that the case? Well, before we start looking deeper into this and a strategy we call doubling down, in fact, first of all, let's have a look at the roots of Martingale, where it comes from. So Martingale finds its roots in gambling, in fact, and it's one of the main reasons why casinos, for example, have betting minimums and maximums. So Martingale, when talking about gambling, when talking about casinos, you usually look at roulette as a perfect example in this case, and you double down, and you probably have found out that if you, let's say, see a roulette wheel here, and you bet on black, rather sooner or later black will hit. So that's a given, because you have a possibility of 50, not really 50%, 48.9, I think 48.9%, 48.9. Yeah, I think so. Yeah, because of the zero. Yeah, we have to calculate this. But all in all, we can say we bet, let's say, 10 euros on black, we have red. Next hand, we bet 20 euros on black, again, red. Next hand, we play 40 euros on red. On black, and then black hits. We make 40 on our investment, and before that we lost 30, so we make 10 euro profit, in fact. So now the thing is that there's a betting amount which is the maximum, in fact, when playing black roulette, because they say you have the allowance to bet as high as 12,000 euros, I think. So at least here, this is in German casinos, it's the case. And this is something which limits the success, the chances of success, because you easily reach these levels quite quickly. And it could easily be that there's a run of 15, 20 black or red, whatever, in a row, which means that you can only bet the amount and then gain back some of the lost money already. So which already shows how much money you have to put at risk here, or you have to take with you to be capable of playing this game, in fact. And so what is the main idea behind Martingale? Well, it's a strategy which relies on the concept of so-called mean reversion, which suggests that asset prices, for example, and historical returns eventually will revert to the long-run mean. To take an example right from now, when, for example, looking at the tech sector here in the US and the developments we see, for example, when looking at stock prices like Nvidia or Apple or Amazon, you can see that the market has performed extraordinarily well over the last 5 months and was, in fact, the main driver for this bullish developments in not just the tech sector, but it pushed also the S&P higher. So I saw a chart today which showed that the performance of was it FANG? I think, I'm not really sure. Let me just have a look here. Was it FANG? It was not really, not necessarily, because Netflix not within that. Facebook, Amazon, Apple, Microsoft, and Google from the March lows performed 35%, and the S&P within the same time span now which made new all-time highs, is 2% higher than 5 months before, while over nearly 500 stocks trade at a minus 5% on average, in fact. So, and this performance on the upside from these stocks I just mentioned, not taking NVIDIA into account, but have a look at NVIDIA too. It's very interesting and very extended on the upside. What you see there is, and this is usually something you would then say the market has to finally see a corrective move, one rather sooner than later, is that it's very extended on the upside, and that you expect the market to pull back to the, for example, SMA 200, so the simple moving average 200, for example, and that's what you bet on once you do such a mean reversion trade, because this is what we talk about when we say extended on the upside in relation to the mean. In fact, and Martingale tries to profit from these developments, in fact. And let me just have a look here. So, oh, there we go. Okay. So now what we want to do to introduce this topic a little better probably is we want to play a game in this context. So what we do is that we say we have an initial bet that is doubled each time the bet becomes a loser. Okay, so if we, for example, flip a coin in this context, then we'll see how Martingale works. So we bet heads, and we bet heads all the time. I already, to some extent, I already introduced this, but now this is another example. We played this game already several seconds, minutes before with roulette. It's the same idea behind that. Now we play, we flip a coin. So we have heads and we have tails. Probability of heads and tails is 50% in this case. And our wager should be $1 in this case. So heads is what we bet. We see a flip result, which is heads. So we have a profit, a loss of our equity, which is an initial equity. We have $10. And so we make $1 profit. Now our equity is $11. And then the next bet we do is heads. Our wager is again $1. Then we have tails. We lose $1, and our equity goes down to $10 again. So what we won here in the first first coin flip is what we lose here. Now third game we play heads again. Our wager is $2, and the flip result is tails again. So we are losing now $2 from our initial equity stake of $10, which brings us down to $8, which is now that we say, okay, let's flip the coin again. We now say our bet is heads, but instead of $2, we double down and we double the amount we bet before from $2 to $4 in this case. So now the result is heads, and our equity goes up $4 because this is what we just gained here, and goes up from $8 to $12, which means now we're again ahead. Okay, so that's the basic idea behind playing Martingale. So now what we want to do is we want to play this game again, but I will show you what happens if you have a losing streak, which is natural. Just remember, we already had webinars here on, for example, Monte Carlo simulations. You probably remember that we run a trading strategy which had a back-tested hit rate of something like 50%, slightly below that. I think it was 48 if I'm not mistaken. And so what I did was I put in those parameters around the hit rate, around the payoff ratio, so average winning trade compared to the average losing trade, the ratio. And we simulated several equity curves. But we not only did that, but in addition to that, we also measured the longest streak of winning trades and the longest streak of losing trades within this so-called Bernoulli distribution we use there. And you could see, probably some of you imagine, if not, feel free to check out the video on Monte Carlo simulation within the YouTube channel from Admiral Markets here. What we did, or what we witnessed there, was that there were runs of 10, 15 winning trades, but also losing trades in a row, even though we had a hit rate of 50%. So it's common, and it's something you will rather sooner or later witness, which is why it's so important, especially now when focusing on Martingale, why it's so important, obviously, to make sure that you have an adequate risk and money management plan. What we will finally come to and see, in fact, why it's so important to have such a strict risk and money management plan, because else chances of going bust are increasing, or is extraordinarily high, in fact. And how can we go bust? Well, very simple. Well, we have a 100% success rate until we lose all our capital. That's what we already said at the beginning here. So now what we do is we play the same game. We have now 4 times a row where we lose. And then you can see we have again $10. That was our equity stake. And then we go for heads, and we have our wager of $1. Tails -1 brings us down to $9. 10 minus 1. So the next one, we double down from 1 to 2 then. We say we bet heads, tails again, -2, brings us down to $7. Well, not so good, but we can double down again because we have enough equity at stake. This is something where you can already see why it's so important to have a very deep pocket here, because if you don't have the deep pocket, you're bust in this case after 4 coin flips, in fact. So you bet again heads. Now for $4, you double down again, $2, and you double down, which means makes 4. Tails is the result, brings us down from 7 now to 3. And now you can already see, now we get a problem because we can't double down anymore because we only have $3 left. So to double down, you deposit more, one opportunity, or you say, okay, then I bet $3 and I just hope to double down, and I double down again the next step then, and probably try to recover my prior losses, in fact. And then what you do is you bet $3, you get tails again, and you're bust. And that's why Martingale is such a difficult or not difficult, but it's in fact quite easy. But why it's a given that you will definitely lose all your money rather sooner than later. And you probably have seen. I unfortunately I just realized I should have prepared a graphic on that, where you can easily see how Martingale looks, or a Martingale strategy looks in terms of an equity curve in the real world. You probably have seen that. And let me just start. I prepared this already because we want to use this in a later stage of the webinar here. But to just give you an idea of how such an equity curve looks like. So what you usually see is small losses. It's like linear, right? So there's no sharper pullback. Then there's the pullback like this, and then we go again higher, and this, and sometimes it's running like that, and then you see the boom. You see this. So if you see an equity curve which looks like that, with like linear equity growth and then a sudden sharp drop, which don't necessarily needs to kill your account or bust your account, could be that it's just a sharper pullback, erasing some of your gains before, and then you take it from there again. Rather sooner than later, there will be the time once the market does not return, and instead you keep on doubling down as long as the margin call hits, in fact. So if you see something like that, you can be pretty sure that this guy you're watching there is trading a Martingale approach. And again, based on my personal experience, in most of the cases, it's really that these guys don't last long in the markets. So usually they think, at least. So it's also a common mistakes which beginners make when start trading with Martingale. They think they found the holy grail. And when seeing such a payout here, such an equity curve, you can be sure that these guys rather sooner or later will go bust due to the system reaching its limits in regards to doubling down, or that they think now I have to put all in one trade to make back all my losses because I was so successful before. What you can definitely assure is that someone is going down with his account, busting his account with a 100% probability if trading Martingale, especially if no adaptations are made in regards to risk and money management. And it's something which is quite common to use, in fact, in Forex trading. And now, again, trading Martingale in Forex trading, this is so interesting because especially in Forex trading, Martingale is very, very risky because FX markets, due to the market depth and also the market width, they tend to be very stable when it comes to trending conditions. So they usually, trends in FX can usually last quite long. The same is also true when looking at other deep markets, let's call them, like, for example, treasuries. So when looking at yields, for example, you will see a high trend stability, in fact. And also, and this is something which is probably right now of high interest, everyone is really looking at this, precious metals, gold, but also silver, for example. Silver is something special, but especially gold. So when you look at a chart, especially at a longer term chart, so daily chart, and you will see that there's usually some very trend stable conditions where you don't see massive pullbacks. So recent volatility we have seen in gold, for example, is very interesting and something which is quite uncommon, because usually due to the high positive correlation of gold, precious metals to yields, and the reason for that is simple. Where is this correlation? Where does it find its roots? Very simple. You have with gold an asset which is not paying any dividends, any yields at all. So it's very yield sensitive, because in an environment where especially risk off hits and usually yields drop because there is a high demand for hedging, for example, market participants tend to buy US treasuries, which is driving US yields lower, which usually results in gold prices to rise also due to the fact that investments in gold become more attractive once yields drop. So there's where this correlation comes from. So if I find out, or if I say that there's usually trend stability in yields, you also have this trend stability usually in gold, for example. And why does it matter when it comes to a martingale? Because you're usually trading a mean reversion approach, which means you try to profit from a corrective move, and you start to build a position against the existing trend, which can, again, as in Forex, but also treasuries and also precious metals, last very, very, very long and can wipe out your whole account, in fact. So very risky means that you risk to bust your trading account. That's what I mean when I say trading martingale is, especially in trading markets, very risky. That means nothing more. It's not just you can lose some of your equity, but you can lose your account. That's what very risky means here. And this is especially true when trading with an inadequate leverage. So if you over leverage your account, the chances of going bust increase dramatically, exponentially, in fact. And so trading martingale doubles down on losses, means that you're gambling with your losses and thus break the rules of good money management. So some might now say, why is martingale not used that often in trading, especially among professionals, if it has such a high success rate, and if there is ways, and where there are ways to somehow adapt the risk and money management? It has to do with the simple fact that you're building a position against the overall existing trend, and thus the overall advantage you usually try to capitalize on, which means nothing more that you're positioning yourself not just against the advantage, but you keep on increasing your position size against this advantage and hope to finally make it into the profit area, at least for 1 or 2 pips or something. And this is doubling down on losses, is something which losers do. And here's a picture from one of the probably most prominent and most successful traders of our time and hedge fund managers. It's Paul Tudor Jones. You probably have seen him in interviews on CNBC. And I love this picture so much, because that was a statement he made in a book called Market Wizards. It was published at the end of the 1980s, I think, probably at the beginning of the 1990s, and it was a webinar, an interview series which Jack Schwager did, and he also interviewed Paul Tudor Jones here. And Paul Tudor Jones made the statement within this book. And what's now very interesting is it's not just that he did this interview with Schwager and was talking to like, okay, let winning trades run, cut losing trades short. But in addition to that, this picture was taken, and you can now see at the wall in the back of a picture which was taken, that he reminds himself over and over again that losers average losers. And this is exactly what we do here. And since you want to be a winning trader, you should avoid this under all circumstances, in fact, not just because it's what a loser does, but it's what someone does who wants to bust his account, in fact. So now let's have a look here at how Martingale works in Forex. And the next step, we then have a look at so-called anti-Martingale strategies and also adaptations you can make once you decide to have this Martingale component included in your trading. So playing Martingale produces a 100% success rate, as we already pointed out, until you lose all your capital. So what we now do is we look here at GBP USD, and we start at a price of 26.50, and we start out with buying one lot here. And our break-even price loss is 26.50. So the account loss is 0, and we don't need to move any pip here to break even on the trade, in fact. So, and now what this system does, or playing Martingale, you probably have heard about this also in another way. If you read something about a grid trading system, this is exactly what we do here. We formulate a grid, a ladder, if you want, and we double down each step. We, in this case, take the ladder one step higher or one step lower. And so now we say every 20 pips GBP USD moves against us, we would double down on our initial position size. So we start at 26.50. So now let's say there's an announcement from whoever, Bank of England, whatever, interest rate decision, whatever might be the driver, GBP USD pushes lower. It goes down to 26.30. So now on our one initial lot we traded, we double down and we add another 2 lots here. And now the question is, okay, what does it mean to our break-even price? And now you start to see if you buy one lot at 26.50 and you buy another lot, in this case, bringing us to 2 lots then in this case at 26.30, well, our break-even price obviously is 26.40. So now we're still down $200 in this case, because we're trading 2 lots and we're down 10 from our break-even price to our from our break-even price to the price where we currently trade. So it's minus 10 pips in this case. So now GBP USD accelerates on the downside. So which means we are down another 20 pips. Now we add another, in this case, 2 lots to our position. So it's 1 lot initially, plus 1 lot brings us to 2, plus 2 brings us to 4, from here 2 to 4. So which brings our price now, our break-even price, down to 26.25, and our overall position down, in this case, 15 pips. So we only need, with 4 lots, to move 15 pips in our direction to be break even. Still, we are down 15 pips on 4 lots, which brings our overall loss down to $600 when trading 1 lot. So now we see market dropping, continuing to drop. So it drops to 25.90. So now it might be 8 lots. When playing Martingale or trading such a grid system, a simple grid system in this case, what we do is we add another 4. We double down on our position size, which is 4, which brings our average price down now to 26.05. 1 second, just let me check. Does it make sense? I think so. Yeah, should make sense. Brings us down to 26.05. the break-even price, which means now we have to see the market move 17 pips in our direction to finally make it to break even. So what you can see here, by the way, I think this is a mistake. That must be a mistake. It doesn't make sense. So usually it should be. Let me just double check that. 1 second, please. I will calculate this. So what we do now is we need we take 2590, we multiply it with 4, and we add another. How much did we have? We had 4 at 26.25, which brings us down to 2607. Does it make sense? 2605. Yeah. Okay, perfect. So now this is a mistake here. So there must be 07 in this case. So then it makes sense with 17 pips from 29 and 90 in fact. So there's a mistake. There should be a 7 instead of a 5. But it doesn't really matter. What you can see is that the market you try to what you do in fact is you bet that the market will rather sooner than later reverse. And the more you build the position up, moving against you, the smaller the move the market has to make in your direction has to be that you can break even again. And in fact, what you will find out if you have enough margin, especially in your account, that this might work 9 out of 10 times. The only problem is that the 10th time will be the one which ruins your account, because then the market does not look back anymore and just keeps on dropping. And there have been days where this happened. In fact, I had a story of a guy whom I met in 2008. No, I'm sorry, 2010. And why is it noteworthy? Well, because that was shortly. It was something like July, August. Yeah, something like that. July, August. That was shortly after this flash crash happened back then in May. Some of you probably remember the 6th of May 2010. If not, just Google it. You will find plenty of information. So this flash crash happened there, and this guy was a short-term trader in the S&P 500, or a trader. So that's how he introduced himself. But after listening to what he had to say, that had nothing to do with trading anymore, because he was all the time trading without a stop, and he was in fact playing such a grid system here, and trading a big position in the S&P 500, being down. That's what he said, over 500,000 at one point, and then seeing the market reversing sharply. And since he doubled down the whole way down, and this massive drop, and that was close to a limit down day that day. So that was really, that was a crazy day. That had never been before. We have never seen something like that before. Since then, it happened quite often, in fact. But still, he was down something like 500,000, he said. And at the end of the day, he was so happy and found himself, or he thought about himself as the greatest trader on earth, because he finished the day up something like 40 grand. Because again, he doubled down all the way. It was very, very short before he received the margin call, and then he saw the market reversing and nearly making back all of the losses before, and adding 40,000 to his trading bankroll. The thing now is that you might say, well, who cares? I mean, making 40 grand in an evening of trading, probably not such a bad salary. I mean, some people work nearly 1 year for that. But the thing is that it was very close that he lost 500,000 within an evening of trading. And there will be days, probably, I have never heard about him before. And we started joking on that. We joked about this and made some fun, and everything was cool. But if I had to bet, I would say that this guy is most likely broke today, because it didn't make the impression on me that he really understood what happened there. So this is where Martingale produces an event which causes you to think that it will most likely work in the long run, which it usually doesn't. And that brings us to the next slide: how to make adaptations when trading Martingale in this case. So when doubling down against the trend is a very risky FX trading strategy, and you should only trade this approach, if at all, in a very low volatile trading and range-bound market environment. Trend following traders sometimes apply a so-called anti-Martingale approach, which is maintaining your position size when you lose, but increasing your position size once you start to profit as a trend starts to build. Okay, so in this case, at Kalu, you sent you want the a webinar recording to your emails being sent. I think this is probably not such a big deal, but probably you're more happy, let's say, if you now hear that the recording will be posted on YouTube, and I think it will be posted there tomorrow at around the same time, 3 p.m. German, so which means around 2 p.m. London then. So you can also set a reminder, just subscribe to the YouTube channel from Admiral Markets, and you will get a direct link or a reminder, whatever, here that this webinar is taking place then. So the recording, if you're interested in that. But beside that, I think this shouldn't be such a big deal to send an email directly to your mail account here with the recording and the link there. But let's come back here to this on the Martingale approach. So what do I mean by that? It's a quite simple way, in fact. It's like you can imagine that as a pyramid, in fact. And this is what you do. You start out with the biggest position size here with, let's say, 8 contracts. And then you keep on building once the trend continues to build and in direction of the overall advantage. So still to be not too close with your average price to the current market environment and have the risk of the market turning against you, especially the older a trend grows, in fact, and seeing the market taking away all of your losses, you start to decrease your position size step by step when you increase the position size then. So you go from 8 contracts to 4, you add 4 to your 8, which brings you to 8 plus 4, it's 12 contracts. And then in the next step, you go for another 2, and then the next you go for 1. So how can you imagine that? Or not imagine, but how can you see how this works? So let's say you decide for whatever reason here to build a position of, let's say, 8 contracts here in this region. Okay, this is where you build the 8. Okay, 8 contracts. So this is where we start. Let me just probably enlarge this a little. What about this? So there we have the 8 contracts. And then the market continues to build, moves in your direction, which is beautiful. And now you say, okay, great, I'll add another 4 contracts in this case to my position. And why do you do that? Because the market just retested a former high here, former highs. And this is then where you say, okay, this is where I add another 4 contracts. So since we do not have clear levels now, it's difficult to say where the average price is, but it should be 4 contracts, but the average price should be, I think, somewhere here. So slightly bringing this trade into positive territory once you move your stop to break even. And so it should be somewhere here within this region. And then you add another 4 contracts, bringing your overall exposure to 12 contracts. So then you take it from here. The market continues to build this structure, in this case, this uptrend. Let me just do it that way. So now you say, okay, I see another pullback here into a former high, which I use to add another step on my way to build a position. So taking it from here, now you see that you add here. Oh, I'm sorry. That's not such a good way. So let's do it that way. So so here we add another 2. Oh, I'm wrong here. That's why. So you add another 2 contracts. And then we go, and you see it's a perfect trend. So great position. And you have here now the last piece, and probably somewhere here you get stopped out for whatever reason. And let me just here at another contract. And now you might probably wonder, okay, this is how we built this anti-martingale. Let me just see, can we increase this? Oh, no, not so much. 1 second. Okay, that's a little unfortunate now. Okay, it doesn't matter. So this is how you build an anti-martingale pyramid, in fact. So you continue to build the position once the market moves in your favor, which is happening, by the way. Don't get me wrong, but this is happening not very often. That the trend is that you catch a trend that perfectly. But once you catch it, you want to get the most out of it. You want to get the most, or you have the advantage on your side, meaning you want to capitalize on the on this trend as strongly as possible to see your equity curve grow. And so now the question you might have is probably, what can we do when it comes to what can we do when it comes to having the stop then? And what you do is, in fact, that you start probably to trail the stop below every relative low, which is built on the way up, in fact. And you move each step of the pyramid here into the profit zone, which means you're already in profit now for the 8 contracts. Once you trail the stop to this level, when you trail the stop to this level, you're in profit for the 8 and the 4 contracts, so for 12 contracts, in fact. And you continue to do that, and you hope that this trend continues to build momentum, in fact, and then probably see a final explosion on the upside. Probably something some precious metal traders are currently after, especially with all the fundamental developments taking place and signs intensifying that there is a strong bull market, which builds, in fact. And this is then where, let's say where the money is made, and where you start to profit as strongly as possible from such a trending environment in this case. And here where Martingale, in the adapted way, how we introduced it, starts to show its strengths, in fact. So what we do is we build the position once the market moves in our direction. If we build the position here and the market fails to break higher, but instead moves lower, okay, then we lose on our 8 contracts. This is a little unlucky, but still, compared to what happens once we build a strong trend and continue to grow our position here, it's a small loss compared to the big gains which are made once such a trend develops. And this is how Martingale, in fact, can be adapted and then be used in your trading. And that brings us, in fact, to the summary of these thoughts. So Martingale is based on probability theory and has theoretically a near 100% success rate. And theoretically, since you need a significant supply of money, infinite money, to achieve 100% profitability, Martingale relies on the concept of mean reversion, which suggests that asset prices and historical returns eventually will revert to the long run mean, in fact. And the strategy involves an initial bet that is doubled each time the bet becomes a loser. And you've seen, by the way, we haven't built a tower, let's call it. But what we did, so usually a pyramid here, it becomes if you reduce the position size, so you increase the position size, but still you reduce the size. While a Martingale system is the opposite. So you start out with 1 contract and you double up, which means nothing more than you're also you're moving the average price of your position very, very strongly after your price. Sometimes it could make sense to build such a pyramid which is standing on its top, but the market conditions, which are not very common and often happening, in fact, once you build a classic pyramid here, they are even more uncommon to build a pyramid which justifies to build a pyramid which is standing on its top, in fact. And it's a very risky trading approach when done wrong, and is often adopted from trend followers to an anti-Martingale approach. So this is what I recommend, in fact. When trading a trend, building a position, then you can use Martingale, but in fact anti-Martingale, and build a pyramid by reducing each step you make, each time you add to your initial position. And why you do that is simple, because the trend also grows older, and the longer trend runs, the more likely it is that rather sooner or later the trend will revert then. And this is something where you want to be positioned in the lowest possible size, while you already capitalized massively on your big position size you started to build early on. And that's it on Martingale. So don't forget to join us next time. Paul will be here on Monday, how to trade 4-hour FX markets, including here, especially for part-time traders, including what you need to be aware of when trading 4-hour market charts. What are the pros and cons of trading these 4-hour charts, and what are good trading strategies for the 4-hour chart. Same time in London, 2 p.m. London on Monday, so 24th of August. You will send, once you listen to this right now here, live in the webinar, you will get the a link to your inbox being sent directly. If you watch this on YouTube, and if you like what you've just seen, witnessed, then please leave a like here, leave a comment here, share the video, subscribe to the channel, and if you want to join live and ask your questions directly to me, feel free to head over to abnormalmarkets.com, and there to the education and webinars tab, or education and then webinars, and there you find the Trading Spotlight webinar link where you can register completely for free. And yeah, so these are the details for the website. These are the contact details, and here's the risk disclaimer at the end. And that's it from my end. So all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday again. I look forward to it. See you. And